Welcome back to the deep dive. We are taking a stack of Q1 2025 energy reports. You know, ExxonMobil, Chevron, Berkshire Hathaway Energy, and yeah, even Tesla.
Right. And we're aiming to sort of cut through the noise.
Exactly. Deliver the essential strategic knowledge. Our mission today, it's pretty straightforward. Give you the shortcut to understanding what these corporate giants prioritize, especially when market conditions were, well, anything but certain.
Yeah.
You want to know how they generated value, what surprising pivots they might have made, and how they position themselves, against this backdrop of global complexity.
What stands out almost immediately in these Q1 results is the sheer financial resilience right across the board. The 2025 landscape, it was definitely marked by volatility, yet these companies, they were executing these long-term strategies. You saw a real focus on operational efficiency, very disciplined capital allocation.
Okay.
They were adapting quickly to geopolitical shifts, yes, but maybe more importantly, they were building this deep financial buffer.
Right. And when you look at that buffer, the first thing that really hits you, heading into our first section here, is just the massive cash engine powering these operations. Forget the top-line revenue for just a second. We really need to talk about cash flow generation. ExxonMobil, or XOM, they posted phenomenal numbers.
They really did.
They reported $7.7 billion in earnings, which is strong, but look at the cash generated from operations, $13.0 billion.
Wow.
Which then translates into $8.8 billion in free cash flow. That's like an industrial-scale financial engine just running at full tilt. That's cash they can deploy instantly.
And that scale is just crucial.
Yeah.
If we look over at Chevron, they also delivered really robust numbers, $3.5 billion in earnings, $5.2 billion in cash flow from operations.
Still very strong.
Very strong. And these figures, they send a clear signal. They tell you that, regardless of commodity price fluctuations, the underlying physical business, actually getting oil and gas out of the ground, is exceptionally efficient and profitable.
So while the major's resilience is often, tied to commodity prices, let's maybe look at a completely different kind of financial strength. Berkshire Hathaway Energy, BHE.
Ah, yes.
This gives us a really fascinating counterpoint, doesn't it? Showing success that's less about the price of crude and maybe more about regulatory structure.
That's a really key detail to pull out from these sources. BHE, and this includes its railroad BNSF, saw operating revenues from agricultural and energy products climb, modestly to $1.6 billion.
Okay.
But the fascinating nugget here is, in their other energy businesses, net earnings there increased by $65 million. And it was driven primarily by higher distribution revenue.
Why?
Because that revenue is subject to inflation adjustments. It's baked into the regulatory framework.
Ah, okay. So while ExxonMobil is out there battling the global crude market, BHE is succeeding partly because their regulated assets automatically adjust for inflation.
Exactly.
So that $65 million gain, it's essentially like a successful passive indexing strategy, but tied to inflation. It completely insulates them from some of the volatility facing the oil major.
It really highlights how vital diversification can be, even within the single banner of energy.
Absolutely.
It shows that stable, regulated infrastructure, it can generate returns just as reliably sometimes as high-risk, high-reward exploration.
Wait, that brings us nicely to Section 2 then.
Yeah.
Shareholder returns. With this, like you said, torrent of cash coming in, how did they signal confidence?
Well, the classic way, right? Returning cash to shareholders.
Right.
This is really where that capital discipline becomes visible.
Yeah.
You look at XOM, they distributed a staggering $9.1 billion back to shareholders just in Q1 2025.
$9.1 billion.
Yeah. And this commitment, it was split. $4.3 billion in dividends and $4.8 billion in systematic share repurchases.
Okay, that share repurchase number, $4.8 billion, that's massive, especially since, as you said, it aligns perfectly with their ongoing annual $20 billion buyback commitment running through 2026. Plus, they declared a stable Q2 dividend, Xyl, or 99 cents per share. But that size of repurchase, it does raise an immediate question, doesn't it? Is plowing nearly $5 billion into buying back stock a signal of unwavering confidence in their own valuation? Or does it maybe hint that they lack enough high-quality, high-return internal investment opportunities compared to just shrinking the share count?
That's precisely the tension investors are watching. The companies, they argue it signals discipline and efficiency.
Right.
By prioritizing reducing outstanding shares, they're basically telling the market, look, our stock is the best investment we can find right now. And Chevron, well, they adopted a pretty similar posture. They returned $6.9 billion, $3.9 billion of that through repurchases, and $3.0 billion in dividends. Their quarterly dividend stands at $1.71.
Okay.
So for both of them, that sustained yield, a predictable repurchase schedule, it's really designed to create a kind of floor against market instability, reassuring investors that capital allocation is still focused on maintaining value.
So, okay, they're satisfying current investors with returns. The next big question then moving into Section 3 is, what are they actually building for the future?
Right.
If we connect this cash deployment to the bigger picture, where are these giants placing their forward strategic bets?
Well, the primary focus, at least for the oil majors, it still remains on these high-value, high-efficiency assets. They like to call them advantaged assets.
Advantaged assets, right, for listeners who might need a quick definition.
Sure. Basically, advantaged assets are projects, think places like the Permian Basin or deepwater Guyana, where the cost of lifting a barrel of oil is dramatically lower than the industry average.
Okay, lower cost.
Which means they stay profitable even if crude prices fall sharply. It gives them resilience.
And XOM is placing massive bets here. Their Q1 cash capital expenditures, CapEx, were $5.9 billion. That's perfectly on track for their full-year guidance of, what, $27 to $29 billion?
Right.
And that investment, it's targeted at achieving a huge strategic goal, getting over 60% of XOM's total production from those advantaged assets by 2030.
Yeah, that's a fundamental shift.
It really is a fundamental realignment of their whole business mix.
But this is where Chevron throws a truly unexpected strategic curveball.
Okay.
While they are still investing traditionally, they commenced production at the deepwater Ballymore field in April 2025, looking to boost Gulf production. They're also pivoting toward pure infrastructure to meet completely new energy demand.
Ah, the AI connection. This was the big eyebrow raiser from the sources, wasn't it?
Exactly. Chevron is advancing a gigawatt-scale power solutions venture, and it's specifically designed to support the U.S. AI data center build-out.
Wow.
This isn't drilling for oil. This is massive, stable electricity generation and delivery. They are explicitly targeting the immense energy demand required by this, artificial intelligence infrastructure boom.
Wait, hang on. Chevron pivoting to power AI data centers. That feels like a huge infrastructure bet. Seems totally different from their core business of, drilling.
It is different.
Does this signal they view future electricity demand as maybe a safer, more stable revenue stream than long-term crude prices? What's the thinking there?
I think it signals they view unmet energy demand, specifically electricity for data centers, as an extremely high-margin opportunity that needs gigawatt-scale solutions, like yesterday.
Right, the demand is surging.
Exactly. The move reflects this growing consensus that AI is going to be one of the largest drivers of power consumption over the next decade. And, well, you can't really talk about that kind of power consumption without talking about storage.
Good point.
And the sources confirm Tesla's megafactory in Shanghai produced over 100 megapacks just in Q1 2025.
Which is absolutely key, right? Because massive battery storage like that is necessary for the stable grids needed to fuel those exact AI data centers that Chevron is now targeting.
Precisely.
It really shows the future energy landscape is rapidly integrating, isn't it? Fossil fuels, renewables, storage, all driven by this new technological hunger for power.
This shows the convergence is happening right now. You can see it on the CapEx sheets.
Yeah. That said, looking at the numbers, it wasn't exactly a perfect quarter across the board.
No, definitely not.
Section 4 really covers the headwinds they faced and the, aggressive efficiency drives needed to counter them.
Yeah, volatility was really the defining characteristic of Q1 2025 earnings. For XOM, profits were definitely hit by weaker crude prices and also a significant decline in industry refining margins.
Ouch.
Yeah, these macro factors, they really cut into earnings, even though those cost savings we talked about provided, a partial offset.
And Chevron also felt the pressure. They reported lower income from their upstream and downstream equity affiliates, combined with reduced refined product sales margins. Plus, they had to deal with the unpredictability of unfavorable tax swings and foreign exchange effects. It sounds like it was a quarter where market conditions were certainly pushing against profitability.
Definitely pushing. And we can't ignore the persistent geopolitical risk either. Tesla, for instance, they specifically acknowledge the immense difficulty in accurately measuring the financial impact of shifting global trade policy, how it affects their automotive and energy supply chains, their cost structure, even consumer demand. When trade risks are that nebulous, that hard to pin down, agility becomes absolutely mandatory.
And the industry's response to that volatility seems to have been this aggressive structural efficiency push.
Exactly. And this isn't just temporary cost-cutting measures. These look like fundamental operational resets.
Okay.
ExxonMobil is really the exemplar here. They've achieved $12.7 billion in cumulative structural cost savings versus their 2019 baseline.
Cumulative, wow.
Yeah, with the solid $0.6 billion saved in Q1 2025 alone. And their goal is monumental. $18 billion in cumulative savings by 2030.
$18 billion. That's how they insulate themselves from the next oil price shock, isn't it?
Pretty much.
By making the permanent cost structure lower, they ensure profitability, or at least better profitability, even if the market turns really sour.
Precisely. And Chevron is following suit. They announced a simplified organizational structure targeting a reduction in structural costs by $2 to $3 billion by the end of 2026.
2 to 3 billion, also significant.
Very significant. This aggressive structural focus on cost is really what separates the resilient players from the more vulnerable ones moving forward.
So, okay, let's try to summarize the Q1 2025 picture for you, the listener. What we're seeing is a sector with pretty robust financial health overall, built on massive, efficient cash flow. Just look at ExxonMobil's $8.8 billion in free cash.
Yeah, that's the foundation.
That cash is being returned via huge buybacks, signaling confidence, but simultaneously it's funding crucial strategic growth, both in traditional advantage assets like Guyana and, maybe more surprisingly, pivoting into massive new energy infrastructure for AI, driven by that Chevron gigawatt venture. And underpinning all of it is this disciplined, structural cost control, aiming for billions in guaranteed future savings.
I think the key takeaway is that this sustained focus on efficiency, it ensures these giants are building a really crucial buffer against instability. They're responding agilely to the current headwinds, yes, but their long-term growth objectives. They remain firmly focused on where they believe they can operate most profitably, whether that's oil and gas or these new electricity demands.
It really is a fascinating dual strategy developing. On one hand, the energy sector is intensely focused on returning cash and growing that high-margin traditional production. But like you said, the sources clearly show they are now aggressively funding future electrification needs as well. Which brings us to our final thought for you to chew on. The energy sector is intensely focused on returning cash. We see that clearly. But how quickly will the traditional metrics, barrels of oil and gas production, be balanced or maybe even superseded by the massive capital expenditure required to fuel this emerging AI infrastructure energy demand?
That's the big question.
Which metric will investors prioritize 5 years from now? Keep watching those CapEx reports. They really do tell the true story of where the future bets are being placed.